Friends, thank you for being here today. What if I told you that the housing market everyone called the safest in the G7 just recorded a 300% surge in missed mortgage payments? What if the very foundation of Canadian household wealth, the idea that real estate is an unshakable store of value, is not just cracking but actively imploding in real time? Let me give you a number that should stop you in your tracks. More than 11,000 households in Ontario alone recorded a missed mortgage payment in the last quarter, not a year, a quarter. To put that in perspective, that's triple, 300% higher than the levels we saw in 2022. This isn't a statistical blip. This isn't a temporary adjustment. This is a structural fault line opening beneath the feet of millions of Canadians who believed they were standing on solid ground. We're not talking about speculation anymore. We're not talking about some future hypothetical crisis. We're talking about a mathematical reality that is already unfolding. The data is clear, the pattern is unmistakable, and the implications are staggering. Ontario, the economic engine of Canada, is turning into what I call a liquidation zone, a place where forced sellers outnumber willing buyers, where equity evaporates faster than mortgage debt can be paid down, and where the illusion of permanent wealth meets the harsh reality of leverage unwinding. This is a singular inevitability, and if you're not prepared, you're about to find out what happens when an entire generation discovers that paper wealth was always just that, paper. Now, before we go deeper into what's happening right now in Ontario, we need to understand how we got here. Because this crisis didn't start with today's news. It started decades ago with a decision made not in Toronto or Ottawa, but across the Pacific Ocean in Tokyo. The year was 1990. Japan, after a decade of the most spectacular asset bubble in modern history, watched its real estate and stock markets collapse. The Nikkei fell from 39,000 to under 15,000. Property values plunged 60%, 70%, in some cases 80%. The Bank of Japan, desperate to prevent a complete deflationary spiral, did something unprecedented. They dropped interest rates to zero, not 1%, not 0.5%, zero, and they kept them there for decades. What did this create? It created what global investors would come to call the carry trade, a machine that would quietly reshape the architecture of the entire global financial system. Here's how it worked in the simplest possible terms. Imagine you could borrow $1 million at 0% interest, not 2%, not 1%, zero. Now imagine you could take that borrowed money and invest it anywhere in the world where you could earn 3%, 4%, 5%, or even 10%. The difference between what you pay to borrow and what you earn on your investment, that's your profit, and it's essentially risk-free as long as nothing changes. This is what global banks, hedge funds, and institutional investors did for 30 years. They borrowed trillions, yes, trillions, in Japanese yen at near zero cost and deployed that money into higher-yielding assets around the world. U.S. treasuries, European bonds, emerging market debt, and critically, real estate in places like Canada, Australia, and the United States. This wasn't some obscure financial tactic. This was the engine. The carry trade, fueled by Japanese liquidity, became the single largest source of easy money in the global economy. Estimates put the size of this trade at over $20 trillion. To put that in perspective, that's larger than the entire GDP of the United States. And here's the crucial part. This money didn't just inflate asset prices. It distorted the entire perception of what assets were actually worth. When money is free, when liquidity is infinite, when the cost of borrowing approaches zero, prices stop reflecting intrinsic value. They reflect the availability of credit. They reflect the flow of liquidity. They reflect the illusion. Now let's bring this back to Canada, because while Japan was keeping rates at zero, something else was happening in North America. After the 2008 financial crisis, central banks in the US, Canada, and Europe followed Japan's playbook. They slashed rates. They engaged in quantitative easing, which is just a fancy way of saying they printed money and used it to buy government bonds, driving down yields across the board. For more than a decade, from 2008 to 2022, Canadians lived in an era of historically cheap debt. Mortgage rates fell to levels that had never been seen before. 5-year fixed mortgages dropped below 2%. Variable rates hovered near 1%. The Bank of Canada, like every other central bank, became a money printer. And Canadians, like people everywhere, did what humans do when money is cheap. They borrowed. But here's what most people don't understand. When central banks print money and suppress interest rates, they're not creating wealth. They're creating claims on wealth. They're creating a system where the price of an asset, like a house, goes up, not because the house is producing more value, not because incomes are rising, but because the debt required to buy that house is cheaper. Think of it like this. If you can borrow $1 million at 2% interest, your monthly payment is roughly $3,700. But if rates rise to 5%, that same $1 million mortgage now costs you $5,800 per month. Same house, same square footage, same location, but your carrying cost just increased by 57%. That's not a market correction, that's a liquidity squeeze, and it's what's happening right now across Ontario. Now, I want to pause here and address something that I know is on your mind. You might be thinking, wait, if this is such a huge problem, why isn't everyone talking about it? Why aren't the headlines screaming about this every single day? The answer is something I call normalcy bias. Human beings are hardwired to believe that tomorrow will look like yesterday. We assume that the patterns we've lived through, rising home prices, low interest rates, endless refinancing options, will continue indefinitely. We dismiss data that contradicts our lived experience. We rationalize away the warning signs, but the data doesn't lie. And right now, the data is screaming. Let me walk you through exactly what a missed payment means, because this is crucial. When we talk about mortgage arrears, we're not talking about foreclosure, not yet. A missed payment is an early stage distress indicator. It means a borrower is 30 days or more past due. It means cash flow has broken down. It means the household is in trouble. Now, banks don't immediately foreclose when someone misses one payment. They work with borrowers. They offer payment deferrals. They restructure terms. But here's the thing, a spike in missed payments is a leading indicator. It precedes forced sales. It precedes listings flooding the market. It precedes price corrections. And that spike is not subtle. Ontario mortgage arrears were near historic lows in 2021 and 2022. Why? Because home prices were soaring, because rates were near zero, because everyone who was over-leveraged could simply refinance and pull equity out of their homes. But when the Bank of Canada started raising rates in 2022, that entire scaffolding collapsed. Missed payments have now increased multiple times over from their trough, and the increase is not linear, it's exponential. Growth is accelerating. That tells you this is not a one-off shock. This is a structural break. So why is Ontario uniquely exposed? Why is this province, this region, the epicenter of what I'm calling a liquidation wave? 3 reasons. First, Ontario households carry some of the highest mortgage debt ratios in Canada. The average household debt to income ratio in the Greater Toronto Area is over 170%. That means for every dollar of income, households owe $1.70 in debt. Compare that to the US, where the ratio is closer to 100%. Canadians, and particularly Ontarians, are leverage addicts. Second, the GTA has the largest concentration of variable rate mortgages in the country. During the low-rate era, millions of Canadians chose variable rate mortgages because they were cheaper than fixed rates. But here's the trap. When rates rise, those payments rise immediately. There's no buffer, there's no delay. And for many borrowers, especially those who stretched to buy at the peak, even a small increase in their payment is enough to tip them into arrears. Third, home prices in Ontario rose faster than incomes during the 2020-2022 pandemic boom. In some parts of the GTA, prices doubled in less than 2 years, but incomes didn't double. Wages didn't keep pace. What that created was an affordability buffer so thin that even a modest shock, a job loss, a rate hike, an unexpected expense is enough to break the household budget. And now all three of those factors are converging at once. This is not a coincidence. This is a mathematical endgame. But the real catalyst, the event that is turning missed payments into a flood, is something that most Canadians still don't fully understand: the variable rate renewal wall. During the pandemic, millions of Canadians took out variable rate mortgages at rates below 2%. But many of those mortgages had a feature that allowed borrowers to keep their monthly payments fixed even as rates rose. How? Through something called negative amortization. Instead of increasing the payment to match the higher interest, the extra interest was simply added back onto the principal. In other words, borrowers were allowed to defer the pain. They kept making the same monthly payment, but their mortgage balance was growing, not shrinking. Now, here's the problem. That deferral doesn't last forever. It ends at renewal. And for hundreds of thousands of Ontario households, that renewal is happening right now. In 2025, 2026, and 2027, a wave of variable rate mortgages is going to reset. And when they do, borrowers are going to see payment increases of 20%, 30%, in some cases 40% or more. Let me give you a concrete example. A household that was paying $2,500 a month in 2021 on a variable rate mortgage could now be facing a payment of $3,500 or even $4,000 per month at renewal. That's an extra $500 to $2,500 per month. For a family already stretched thin, that's the difference between staying in their home and walking away. And this isn't speculation. This is already happening. The data on missed payments is the evidence. The 300% surge we're seeing in Ontario is the first wave, but it's not the last. Now, let me show you what happens when the liquidity tide goes out, because we're about to find out who's been swimming naked. The trigger event is this: the Bank of Canada, after holding rates near zero for over a decade, raised its policy rate from 0.25% in early 2022 to 5% by mid-2023. That's a 4.75 percentage point increase in less than 18 months. To put that in historical context, that's the fastest tightening cycle in Canadian history, faster than the 1980s. Faster than the 1990s, faster than anything we've ever seen. And here's why that matters. When central banks raise rates, they're not just making borrowing more expensive. They're draining liquidity from the entire system. Every percentage point increase pulls billions of dollars out of circulation. It makes credit harder to access. It makes refinancing more difficult. It makes the cost of carrying debt more punishing. But the effects don't hit all at once. They cascade. They spread through the economy like a slow motion avalanche. And right now, that avalanche is hitting Ontario's housing market with full force. Let me show you the canaries in the coal mine. Let me show you the forensic evidence that proves this rot is not theoretical. It's real, it's spreading, and it's accelerating. First, let's look at the missed payment data itself. In the first quarter of 2022, when rates were still near zero, Ontario recorded fewer than 4,000 missed mortgage payments. By the fourth quarter of 2024, that number had surged past 11,000. That's not a 10% increase. That's not a 50% increase. That's a 175% to 300% increase, depending on how you slice the data. But here's what makes this even more alarming. This surge is happening while home prices are still elevated. Prices in the GTA are down from their peak, yes, but they haven't crashed. They're still 40% to 50% higher than they were in 2019, which means borrowers who are missing payments right now aren't underwater yet. They still have equity on paper. But that equity is vanishing in real time because when you miss a payment, you can't refinance. When you can't refinance, you can't access that equity. And when you can't access equity, you're trapped. You're stuck between rising carrying costs and falling access to liquidity. That's the definition of a liquidation zone. Now let's zoom out and look at the broader pattern. Mortgage arrears data captures borrowers who are 30 days or more past due. That's an early stage distress signal. It's not foreclosure. It's not a forced sale. Not yet. But it's a leading indicator, and historically, arrears rise well before forced sales appear in listings. Here's the sequence. First, borrowers miss one payment, then they miss two, then they try to work with the bank to defer or restructure. But if rates stay high, if income doesn't increase, if home prices don't rebound, eventually those borrowers run out of options. And when they run out of options, they become forced sellers. Forced sellers are different from discretionary sellers. A discretionary seller can wait for the right price. They can pull their listing if the market softens. They can hold on for another year. But a forced seller can't wait. They need to exit. They need liquidity. And that means they accept below market pricing to close the deal. And when forced sellers start flooding the market, they set new comps. They set new price benchmarks, and those benchmarks pull down the valuations of every other property in the area. It's a downward spiral, and it's already begun. Let me give you a specific example of how this plays out. There's a phenomenon happening right now in the outer suburbs of the GTA, places like Milton, Brampton, Oshawa, where new construction homes purchased in 2021 and 2022 are now being relisted at prices 15% to 20% below their purchase price. Why? Because the buyers who stretched to afford those homes at the peak are now facing renewal shocks they can't absorb. These aren't speculators. These aren't investors. These are families who believed they were buying their forever home, but their variable rate mortgage just reset. Their payment jumped from $2,800 to $3,900, and they can't make the numbers work. So they list and they take a loss, and that loss becomes the new market price. Now, some of you might be thinking, okay, but this is just a regional issue. This is just Ontario. The rest of Canada is fine. And I need to stop you right there, because Ontario is not an outlier. Ontario is the warning signal. Ontario accounts for nearly 40% of Canada's GDP. The Greater Toronto Area alone is responsible for 1/5 of the country's economic output. If Ontario's housing market enters a prolonged downturn, it doesn't stay contained. It spreads. It affects consumer spending. It affects business investment. It affects tax revenues. It affects everything. And here's the uncomfortable truth. Ontario leads the country not just in economic size, but in financial vulnerability. Ontario households carry the highest mortgage debt ratios. Ontario has the largest concentration of variable rate mortgages. Ontario has the thinnest affordability buffers, which means when Ontario breaks, it breaks first and it breaks hardest, but it doesn't break alone. Let me show you why the spike in missed payments is nonlinear, why growth is accelerating, not steady. In a normal economic down cycle, stress builds gradually. You see unemployment tick up slowly. You see defaults rise incrementally. But what we're seeing now is different. the increase is exponential. Why? Because the variable rate renewal wall isn't a gradual slope, it's a cliff. Renewals don't spread evenly over a decade. They cluster. And right now, they're clustering in 2025, 2026, and 2027. That means the stress we're seeing today, the 11,000 missed payments in Ontario, is just the beginning. It's the first wave hitting the shore. The second wave, the third wave, they're still building offshore. And here's the kicker. Even small payment shocks are now causing immediate stress. Why? Because during the 2020-2022 boom, home prices rose faster than incomes, way faster. In some parts of the GTA, prices doubled while incomes rose maybe 10% to 15%. That created thinner monthly affordability buffers. Even before rates started rising, many households were already stretched to the breaking point. Now add a 30% or 40% payment increase on top of that. Add inflation eating away at disposable income. Add higher property taxes, higher insurance premiums, higher utility costs. The math doesn't work. The household budget snaps. And once it snaps, there's no easy way to fix it because refinancing is off the table. Why? Because home appraisals are falling, because banks are tightening lending standards, because the same equity that borrowers thought they could tap into has evaporated. Let me explain how this works mechanically. Imagine you bought a home in 2021 for $900,000 with a 10% down payment. You took out an $810,000 mortgage at 1.5% variable. Your payment was around $2,800 per month. Fast forward to 2025. Your mortgage is up for renewal. Rates are now at 5.5%. Your new payment is $4,200 per month. But here's the problem. You call your bank to refinance and extend the amortization to lower your payment. The bank orders a new appraisal, and the appraisal comes back at $750,000. Your home is now worth $150,000 less than you paid. You're underwater. And because you're underwater, the bank won't lend you more money. They won't extend your amortization. They won't give you any relief. So now you have three choices. One, find an extra $400 per month somewhere in your budget. Two, sell the house, take the loss, and destroy your credit. Three, stop making payments and let the bank force you into foreclosure. None of those options are good. And for thousands of households in Ontario right now, those are the only options on the table. This is what I mean when I say Ontario is becoming a liquidation zone. It's not that everyone is being forced to sell, it's that the people who are being forced to sell have no negotiating power. They have no equity cushion. They have no time. And that creates a self-reinforcing cycle of falling prices and rising distress. Now, let's talk about the psychology of this moment, because what's happening in Ontario right now isn't just a financial crisis. It's a psychological crisis. It's the moment when an entire generation of Canadians who believe that real estate always goes up, that borrowing is always safe, that the government will always step in to protect homeowners. It's the moment when all of those beliefs are being tested. And here's what happens when beliefs break. People don't respond rationally. They don't calmly assess the data and make logical decisions. They panic. They freeze. They cling to denial. They tell themselves that this is temporary, that prices will rebound, that rates will come back down, that everything will go back to normal. But it won't, because this isn't a cyclical downturn. This is a structural reset. The era of free money is over. The era of endless refinancing is over. The era of using your home as an ATM is over. And the people who don't accept that reality are the ones who are going to get crushed. Let me give you another piece of forensic evidence. Canadian mortgages are full recourse. That means if you default on your mortgage and the bank forecloses, they can come after your other assets. They can garnish your wages. They can pursue you for the deficiency. Unlike in the United States, where you can walk away from an underwater mortgage and leave the keys on the counter, in Canada, you can't escape. And that changes the psychology. It means borrowers don't walk away easily. They fight, they defer, they borrow from family, they drain their savings, they liquidate their RSPs, they do everything they can to avoid foreclosure, which means the stress doesn't show up as instant foreclosures. It shows up as prolonged arrears. It shows up as missed payments. It shows up as financial desperation. And that's exactly what we're seeing in the data. Rising arrears signal structural affordability failure. They signal that the carrying costs of home ownership have exceeded the ability of households to pay. And when that happens, the system starts to unwind. But here's the part that terrifies me, because it should terrify you too. The stress we're seeing right now is happening with unemployment still relatively low. The Canadian unemployment rate is hovering around 6%, which is elevated but not catastrophic. If we see a recession, if unemployment spikes to 8% or 9%, if layoffs accelerate, the number of missed payments won't triple. It will quintuple, maybe more. And at that point, the banks themselves come under pressure. Because remember, banks are leveraged institutions. They borrow short and lend long. They rely on the assumption that most borrowers will keep paying. But if arrears surge past a certain threshold, if foreclosures spike, if forced sales flood the market and drive prices down 20%, 30%, 40%, then the banks start taking losses on their mortgage books. And when banks start taking losses, they tighten credit even further. They stop lending. They stop refinancing. They call in loans. And that creates a vicious cycle. Less credit, more defaults, lower prices, more stress, even less credit. This is not 2008. I want to be very clear about that. Canada has stricter lending standards than the US did before the subprime crisis. Canadian borrowers can't walk away from their mortgages. The structure is different. But don't let that lull you into complacency, because the danger here is not a sudden collapse. The danger is a slow, grinding, multi-year downturn where prices fall steadily, arrears rise steadily, forced sales increase steadily, and household wealth evaporates steadily. It's death by 1,000 cuts, and it's already begun. So let me ask you this. If you own a home in Ontario, if you're sitting on a variable rate mortgage, if you're facing a renewal in the next 12 to 24 months, what's your plan? Because hoping that rates come down is not a plan. Hoping that prices rebound is not a plan. Hoping that the government steps in with some kind of bailout is not a plan. The liquidity tide is going out, and we're about to find out who's been swimming naked. So let's bring this all together, because what we're witnessing in Ontario right now is not just a housing correction. It's not just a rate shock. It's a convergence, a perfect storm of three distinct forces hitting at the exact same moment. First, we have the structural break in the global carry trade. For 30 years, the world ran on cheap Japanese money. $20 trillion borrowed at near zero and deployed into every asset class on Earth. That scaffolding just cracked. Japan is raising rates. The yen carry trade is unwinding. And when that money flows back to Tokyo, it drains liquidity from everywhere else, including Canada, including Ontario real estate. Second, we have the domestic liquidity crisis. The Bank of Canada, after the fastest rate hiking cycle in history, has pulled trillions in liquidity out of the Canadian financial system. Credit is tighter. Refinancing is harder. The spigot of easy money has been turned off. And without that constant flow of cheap credit, asset prices can't be sustained at artificial levels. Third, we have the variable rate renewal wall, a wave of mortgage resets that will force hundreds of thousands of households to confront payment increases they cannot afford. This isn't a hypothetical future event. It's happening right now. The 11,000 missed payments in Ontario are just the leading edge. The peak hits in 2026 and 2027. And when it does, the number of distressed borrowers will not be in the thousands. It will be in the tens of thousands. These three forces are not independent. They're interconnected. They feed off each other. And together they create what I call a debt trap environment, a place where borrowers are squeezed from every direction with no escape route. Now, I want to shift gears for a moment because understanding the mechanics of this crisis is important, but it's not enough. What matters more is understanding your own psychology, because the biggest threat you face right now is not the data. It's not the missed payments. It's not even the rate hikes. The biggest threat you face is normalcy bias. Let me explain what I mean. Human beings are wired to assume that the future will resemble the recent past. If home prices have gone up for 20 years, we assume they'll keep going up. If we've always been able to refinance, we assume we'll always be able to refinance. If the government has always stepped in during crises, we assume they'll step in again. This is not stupidity. This is evolutionary psychology. Our brains are optimized for pattern recognition and stability, but that optimization becomes a liability during structural breaks, during moments when the rules of the game fundamentally change. And that's what's happening right now. The rules have changed. The system that produced rising home prices, easy credit, and infinite refinancing, that system is breaking down. But because the breakdown is gradual, because it's not a single catastrophic event, most people don't see it. They rationalize it. They tell themselves it's temporary. They cling to the belief that everything will go back to normal. It won't. Let me give you another psychological concept that's critical to understand: the money illusion. This is the phenomenon where people confuse nominal wealth with real wealth. You look at your net worth on paper and it says you're a millionaire because your house is worth 1.2 million. But then you go to the grocery store and your cart costs $300. You go to fill up your car and it costs $90. You look at your property tax bill and it's $8,000 a year. You're a millionaire on paper, but you're getting poorer in real terms. Your purchasing power is eroding, your disposable income is shrinking, and the equity in your home, the thing you thought made you wealthy, is trapped. You can't access it without selling. And if you sell, you realize a loss, so you're stuck. This is the insidious nature of a debt-driven asset bubble. It creates the illusion of wealth while simultaneously destroying the foundations of actual prosperity. And when that illusion finally breaks, the psychological damage is profound. Because here's what happens next. Homeowners who believed their wealth was secure, who believed their home was their retirement plan, who believed they could always borrow against their equity, they start to realize that none of that is true. And when that realization hits, behavior changes. Consumer spending drops. Business investment collapses, the economy contracts, and that contraction feeds back into the housing market, pushing prices down further. This is not a conspiracy. This is not some shadowy plot. This is just math. This is just the natural consequence of a system built on ever-increasing leverage, meeting a world where credit is no longer expanding. So now let me ask you the most important question. What do you do about it? Because understanding the problem is only half the battle. The other half is action. And the action you take or don't take in the next 12 months could determine whether you preserve your wealth or watch it evaporate. Here's the binary choice you need to make. Do you own assets or do you own claims on assets? Let me explain the difference. When you own a share of stock, you own a claim on the future earnings of a company. When you own a bond, you own a claim on the future payments from a government or corporation. When you own a house with a mortgage, you own a leveraged claim on a piece of real estate. But when you own physical gold, when you own land free and clear, when you own tangible debt-free assets, you don't own a claim. You own the thing itself. And that distinction matters. Because in a world where the financial system is built on layers upon layers of debt, where every asset is collateralized multiple times, where leverage is stacked on top of leverage, when that system starts to unwind, the claims become worthless long before the underlying assets do. Let me give you a concrete example. Right now, you might own $500,000 worth of equity in your home. On paper, that's real wealth. But if you can't refinance, if you can't access that equity, if the only way to realize it is to sell into a falling market, then that equity is not wealth. It's a trapped asset. It's a claim you can't exercise. But if you own 1 kilogram of physical gold stored in your possession or in a secure vault, that's not a claim. That's an asset. You can take it anywhere. You can sell it anywhere. You can hold it indefinitely. And most importantly, its value is not dependent on the solvency of a counterparty or the liquidity of a market. Now, I'm not saying everyone should liquidate their home and buy gold. That would be absurd. But what I am saying is this: in an environment where paper wealth is evaporating, where claims are being defaulted on, where the financial architecture is crumbling, the safest place to be is in hard assets that are free from debt and counterparty risk. Gold and silver are the most obvious examples. They've been stores of value for thousands of years. They're no one's liability. They can't be printed. They can't be diluted. They can't be defaulted on. And in periods of financial stress, they outperform everything else precisely because they are the ultimate safe haven. But beyond precious metals, the principle applies more broadly. Land that you own free and clear, productive assets that generate real income, physical commodities. These are the things that retain value when paper burns. And paper is burning right now, maybe not in a dramatic, visible way, but slowly, steadily. The erosion is happening. The value is leaking out of the system. And the people who are still holding on to the illusion, the people who believe their net worth statement reflects actual wealth, they're the ones who are going to get hurt the most. So let me ask you again, what's your plan? Are you going to sit on a variable rate mortgage and hope the Bank of Canada cuts rates in time to save you? Are you going to watch your equity evaporate and tell yourself it's just a temporary correction? Are you going to keep believing that the government will step in with some kind of bailout, even though every bailout so far has only made the problem worse? Or are you going to take action? Are you going to reduce your leverage? Are you going to move capital out of paper claims and into real assets? Are you going to step out of the line of fire before the next wave hits? Because make no mistake, the next wave is coming. The missed payments we're seeing in Ontario right now are just the beginning. The renewal wall peaks in 2026 and 2027. The liquidity drain is still accelerating. The carry trade unwind is still in its early stages. All three of those forces are going to intensify over the next 24 months. And when they do, the stress we're seeing today, the 300% surge in arrears, the forced sales, the falling appraisals, that's going to look mild in comparison. This is not fear-mongering. This is not doom and gloom for the sake of clicks. This is pattern recognition. This is reading the data. This is understanding the mechanics of how over-leveraged systems unwind. And every time in history that we've seen this pattern, 1929, 1989 in Japan, 2008 in the United States, the outcome has been the same. Paper wealth evaporates. Hard assets survive. Now, let me be very clear about something. I'm not telling you to panic. I'm not telling you to make rash decisions. I'm not telling you to sell everything tomorrow and bury gold bars in your backyard. What I am telling you is this: pay attention, question your assumptions, challenge the narrative that everything will be fine. Look at the data, look at the missed payments, look at the renewal wall, look at the liquidity drain, and ask yourself, honestly, whether the plan you have right now is based on hope or on reality. Because hope is not a strategy. Hope is what people cling to when they don't want to face uncomfortable truths. And right now, the uncomfortable truth is that the financial system we've lived with for the past 30 years, the system built on cheap credit, ever rising asset prices, and infinite leverage, that system is breaking. It's not going to break all at once. It's not going to collapse overnight, but it is breaking. The cracks are visible. The stress fractures are spreading. And the people who recognize that early, who adjust their positioning accordingly, who move from illusion to reality, those are the people who will preserve their wealth. The people who don't, they're going to learn a very expensive lesson about the difference between paper and reality. So here's my final message to you, friends. We are living through a moment of transition, a transition from an era of abundance to an era of scarcity, from an era of easy money to an era of expensive money, from an era where everyone could get rich on leverage to an era where only the prepared will survive. History favors the prepared. It always has. The people who saw the Great Depression coming and moved to cash, the people who saw the dot-com bubble and sold at the peak, the people who saw 2008 coming and shorted subprime mortgages, they didn't get lucky. They saw the pattern, they understood the mechanics, and they acted. You have that same opportunity right now. The pattern is clear, the mechanics are visible, the data is screaming at you. The only question is whether you're willing to listen, because the window for preparation is closing. Not tomorrow, not next week, but month by month, the options narrow, the liquidity drains, the pressure builds, and eventually the breaking point arrives. When it does, there will be two groups of people, those who prepared and those who didn't. Which group are you going to be in? Friends, thank you for being here today. I know this is heavy. I know it's uncomfortable, but discomfort is the price of truth. And right now, the truth is that we are standing at the edge of a structural reset. The illusion is collapsing, and reality is about to reassert itself with a vengeance. The question is not whether this is going to happen. The question is whether you're going to be ready when it does. Stay sharp, stay prepared. And remember, gold doesn't default, land doesn't vanish, reality endures. See you in the next one.